Okay, so buckle up because we are diving into the world of oil and gas with ONGC's latest earnings report. I mean, who knew quarterly reports could be this exciting, right?
Well, excitement might be a strong word, but yeah, let's get into it. ONGC, or Oil and Natural Gas Corporation Limited, is like a pretty big deal in India's energy scene. They basically explore, produce, and sell crude oil and natural gas.
Right. They are like the giants of the Indian oil and gas sector. So they've got their hands in both offshore and onshore production, and they even have some subsidiaries like ONGC Videsh for international operations. Pretty interesting, I guess.
Exactly. They've got their fingers in quite a few pies and even have joint ventures. It's quite the operation. And this report, I mean, it gives a snapshot of their financial performance for the quarter and the 9 months ended December 31st, 2024, which is what we'll analyze now, right?
Absolutely. So, first up, the income statement, and what a mix of results it was. Their total income actually decreased compared to the previous quarter and also compared to the same quarter last year. I mean, the revenue was down to about 33,716 crore from 34,788 crore in the same quarter last year.
Well, yeah, but it's not all doom and gloom. There was a big jump in other income, which kind of offset the drop in their operations revenue. So while revenue from core operations dipped, their total income only saw a minor decrease, actually. Think of it like having a slightly smaller main meal, but a really big dessert.
Okay, I see that analogy. So the desserts helped in this case, but when we dig into expenses, well, it shows they're facing some serious headwinds. Statutory levies was still a huge hit, and that's a big part of their total expenses of about 24,527 crore for the quarter.
Oh, yeah. Statutory levies are like those unavoidable taxes and fees, and they always bite into a company's profits. But also, another major portion of expenses is depreciation, depletion, and exploration costs. They're like the cost of wear and tear on their equipment and the costs associated with finding new oil reserves. All that adds up.
Right. So all those expenses added up, and guess what? Their net profit actually saw a significant drop. It fell to about 8,240 crore this quarter from 9,892 crore last year, a 16.7% drop. I mean, that's not great.
Yeah, I mean, a drop like that raises an eyebrow or two. That's a considerable decrease. It does underscore the challenge of rising expenses and fluctuating revenue. It's like trying to stay afloat in a boat with a slow leak. You have to work harder just to stay in place.
Yeah, you're right. Now, let's move to the balance sheet. I mean, it gives a picture of what the company owns and owes. They've got total assets of around 4,52,787 crore, which is pretty hefty, right?
Absolutely, that's a substantial amount of assets. But we also need to look at their liabilities. They have total liabilities of 1,34,429 crore. That, along with assets, shows their financial structure and, if they can cover their debts. And this whole thing is important to look at their solvency.
Right. And their net worth, which is their assets minus liabilities, sits at around 3,18,358 crore. That's still a good sign, but I mean, it's important to monitor these things, isn't it?
Definitely. And it gives us a sense of the company's overall financial health. A high net worth is generally a good sign. It means they have a considerable cushion if things get a bit shaky.
So, moving on to the cash flow, it's the story of how much cash a company generates and uses. And this is quite critical for growth, right?
Well, exactly. The cash flow statement shows how well they manage their cash. If there's enough free cash flow, then they can use that for future expansions or give dividends to shareholders.
Okay, so they've declared a second interim dividend of 5 rupees per share. That's like a 100% payout. That's actually a great sign for investors, isn't it?
Oh, yeah. Dividends are like a reward for investors. It means the company is not just sitting on cash and is willing to share profits with shareholders. That's always a plus.
Okay, so time to crunch some numbers and check out these key financial ratios. These really help understand the company's performance.
Right. Ratios are like a health checkup for the company. They tell us how efficient they are, how profitable they are, and how well they manage debt. It's like a scorecard.
Okay, so let's start with the profitability ratios. Their operating margin for this quarter is around 24%, which is okay, but it's much lower than the previous quarter and also the same quarter last year. So it means less profit from their core operations, I guess.
Exactly, a lower operating margin signals that they're either spending more or making less per sale or a combination of both, which, impacts overall profitability, and their net profit margin is also seeing some decline.
Right. And their net profit margin, which is profit after all expenses and taxes, was down to 24.44% compared to 35.37% last quarter. That's quite a drop, isn't it?
Absolutely. It means they're keeping less of their income as profit after all is said and done. This can be due to higher expenses, lower revenues, or increased tax burden.
Now let's look at debt and liquidity. Their debt to equity ratio is around 0.02, which is pretty low, and it shows that they are not heavily reliant on debt.
That's right. A low debt to equity ratio is a very good sign. It means the company is not overly leveraged and they have a low risk of facing financial problems. Think of it as a company that has their finances in order.
Okay, now what about their liquidity? Their current ratio is 1.74. That's good. It shows they can meet their short-term obligations, which is quite important.
Yeah, a current ratio above 1 indicates that they have enough assets to cover short-term liabilities. And this whole thing assures they have the funds to run daily operations smoothly.
So these financial ratios, it seems like they paint a mixed picture. They are doing well with debt management, but profitability seems to be under pressure. Well, that's what it seems, right?
Yeah, exactly. It shows they have a stable financial position with strong assets and low reliance on debt. However, their profit margins are definitely under pressure, which is what we can extract from the data. It is quite a mixed picture.
Well, let's look at some trends. There is a consistent trend in revenue dips over the past few quarters. Is that something to worry about, do you think?
Well, a dip in revenue over consecutive quarters can be concerning and could point towards some market challenges. It's something investors should keep an eye on for sure.
Also, their profit margins have decreased consistently over the last few quarters as well. So that's something to keep in mind too, isn't it?
Right. Declining profitability is a red flag. It means their expenses are increasing faster than their revenue or their pricing may be less competitive.
Okay, so let's talk about the future. What's the outlook for ONGC? The report talks about some interesting things like new oil discoveries and new projects.
Yeah, they've had 7 new discoveries, 4 on land and 3 offshore. So they are still exploring and finding new resources. Also, the fact they've completed a total infusion of 18,365 crore in Opal, increasing their stake to 95.69%, is a big move.
Also, they've signed a MOU with Power Grid for green hydrogen projects. That shows they are also looking into clean energy. That's a good step, I think.
Oh, yes, that shows they are keeping up with the times and exploring new technologies and are trying to diversify their portfolio into the renewable energy sector. That is for the future. So that's a positive.
Well, overall, they seem to be facing some challenges in terms of profitability, but also they seem to have a strong foundation with a focus on growth.
Yeah, it's a mixed bag. While short-term profitability might be a concern, their long-term strategies and focus on exploration and new energy projects indicate a potential for growth.
Okay. So if I were an investor, what would you say are the key takeaways?
Well, ONGC is a company with a very strong presence in the Indian energy sector and has a stable financial structure. But I mean, right now, their profit margins are facing some headwinds due to rising expenses. However, it's good to see that they are exploring new opportunities for growth and diversification with new discoveries and green energy initiatives.
Yeah, that's a good summary, I think. And it is important to remember that while we do analyze data and give you analysis, it doesn't count as investment advice. And
Disclaimer: we advise investors to check with certified experts before taking any investment decisions.
Absolutely. And if you found this financial analysis intriguing or even just somewhat entertaining, then go ahead and give us a like and subscribe. It helps the channel.
Yeah, and if you have any questions or comments, please drop them down below. We'd love to hear what you think of this financial breakdown. Also, we're always looking for feedback. So please let us know, what would you like us to discuss next?